Good afternoon and welcome to Suffolk's Lunch and Learn, Money Sense, Financial Literacy for Young Professionals. Please welcome Suffolk University alumnus and Vice President of the Graduates of the Last Decade Council, Tyler LeBlanc.
Hello everyone and welcome. I'm excited to be with you this afternoon and serve as the moderator for this program. I'm also excited to introduce you to our alumni speakers. Jim Dever is an alumnus from the Sawyer Business School, earning a BSBA in 1993. For the past 25 years, he has been helping customers reach their financial goals at the Bank of Boston, Boston Private Bank, Rockland Trust, Santander Bank, and at his current role at Century Bank. Marlon Welsh earned a BSBA in 2018 after serving in the Marine Corps prior to enrolling at Suffolk. Marlon is currently working as financial advisor at his own firm and working on finishing his MBA at Suffolk. Jim and Marlon will present for about 35 to 40 minutes, and following their presentation, there will be time for Q&A. If you have any questions, please write it in the chat feature anytime during the webinar, and I'll do my best to get to all your questions in the time allotted. Now, please welcome Jim Dever and Marlon Welsh.
Thank you, Tyler, for that introduction. Welcome, everyone. If we can go to the next slide, that would be great. So my first role is to really talk about some very basics about what to do to kind of plan your financial future. Pay yourself first is one of the most basic things that you can do. What does it mean, pay yourself first? It means put money in a savings before you buy things or pay your own bills. So basically it's looking at anything that you have and do. Before you look at paying other people, look to put aside funds for yourself for those future needs or those goals that you may have set. It seems like a really basic concept, but I would say about 25 people that come to me prior to coming to me, only about 25% of the people will have something in place to do this, to put the plan in place prior to that. You know, it's simple things. As I'll take the Weight Watchers motto there. I tried to look up who said it, and it seems to be what might have been Ben Franklin, but maybe not. When you fail to plan, you plan to fail. So you need to have a plan in place and to do some basic things to pay yourself first. Those basic things really include thinking about, you know, first of all, what funds are we talking about? We're talking about any funds that you get. Those surprise checks that you get for your birthday, those windfalls that you may get from in life. When you get those things, you want to think about how much of that am I going to put towards my savings goal? The other key thing is to put in place a constant savings plan. You can do that in one of two ways. You can set it up directly from your own checking account to move the funds into your savings account on an automatic basis, or you can have your payroll do that. So having your company, it should allow you to do 3 to 4 checking accounts, or I should say 3 to 4 accounts to put your direct deposit in. Segment a certain amount of that paycheck every single pay period to automatically go into your account. You need to set it up automatic or else it doesn't happen. Next slide, please. Again, benefits of paying yourself first. Learn to manage your money better. You know, having that savings or emergency fund is absolutely necessary, and that's the first piece that people should be looking and saving for. Save money towards identified goals. You know, if you're looking to purchase a home, if you're saving to purchase a car, or any other purchases or goals that you may have. It may be a vacation or longer term savings plans such as retirement. Improve your standard of living. Having an emergency fund allows you to have flexibility in the event that maybe you decide to switch a job. If you have that emergency fund in place, you'll be able to have those funds will help you to be able to make those decisions and to carry you through possibly a point where you don't have that other job. And then again, having money for emergencies. You know, there's nothing like COVID to a pandemic to really remind us we all need to have an emergency fund for those what if situations that occur. Next slide, please. I wanted to touch base, really on emergency funds and short-term goals. Those are things that really you should be focused on putting those in a bank or something that is a safety and has insurance where you're not going to lose any investments. Those are short-term investments, and you want those to be in safety rather than in something that may have longer-term growth and not be guaranteed. However, your long-term investments, such as your retirement funds, should always be looked at as putting funds into longer-term investing. Non-deposit investment products are for long-term savings options purchased in future income financial benefit. They're not FDIC insured, so there's not guarantees. However, if you understand your long-term investment, it needs to work harder than your shorter-term investments. So that's why it's necessary to have a portfolio with both of these in there. May earn and grow more than the regular savings account because the risk you are taking when you invest is higher. So next slide. Retirement investments is one of the biggest things that you'll be saving for. Everyone should start saving for the retirement as soon as possible. If you get that first job, you need to take advantage of the retirement aspects that your job may be providing you. Products that you can use for retirement are individual retirement accounts, both Roth and traditional, 401ks and 403b plans, and variable annuities in some senses where those make sense. Next slide. IRAs are really just as it sounds. It's your individual retirement plan. If you don't have a 401k or a 403b, this is an avenue that you can take if you're earning income and you're looking to save money for your retirement. This may include a combination of investments. They are tax exempt, either depositing into them or taking out of them, depending on which type of IRA you choose. They fluctuate. Again, these investments should never be in a bank and should always be in the market or in an investment type instrument. If you're keeping your IRA funds in a bank, you're probably not, as I like to say, you'll retire on tuna fish rather than retiring with lobster. It's not going to give you the growth you need to have over a long-term time frame. So remember that, and don't make sure that your long-term investments are invested properly. Additional IRA, again, traditional and Roth IRAs are the two options that you have. Traditional tends to be taxed when the funds are going in, whereas traditional tends to be you get a tax deduction when the funds are going in, but a tax coming out. Roth there is no tax deduction up front, and you are not taxed on the growth that you make on those funds. Next slide, please. The scariest thing, or the one thing that people don't understand sometimes, is what, you start your first job and you look and you say, my employer's offering me a 401k, a 403b, what is that? Basically, these are retirement plans that everyone should take advantage of. I don't care who, if you don't think you have the money, you absolutely need to take advantage of it for one reason. Almost every plan will have some sort of employer match. So with these plans, your employer will match your contribution depending upon what their percentage is. But if you don't put into these plans, you won't get those matching funds. So it's like throwing money away. It's very important to, again, think about the investment options that are being offered through these plans and to seek out advice from a professional if you're unsure as to what to invest in. The 401k is usually for profit institutions, and 403bs are more for employees of public schools as well as nonprofit organizations. Next slide. And I'm going to now turn it over to my partner, Marlon, and have him give you some more details and get into more specifics.
Thanks, Jim. And I love everything that you said before. It really lays the foundation, like these options that Jim was talking about. Saving and investing doesn't have to be as complicated as so many people think it is. And I think we can all recognize what sounds like a good idea, right? Jim talked about all the different options you have, whether it's a traditional IRA or a Roth IRA, or it's your employer-sponsored plan like a 401k or a 403b. Great, we got it, right? These are good ideas. I don't know anybody who says it's not a good idea to save. But then the question we ask ourselves is like, what's in it for me, right? This is money, I'm putting it away, I don't get to see it. Why is it such a big deal? And the fact of the matter is that so many of us don't realize that we have this real financial crisis in America where people work their entire lives and they literally earn millions and millions of dollars. And when it comes time for them to retire, they pretty much have nothing. I'm going to show you here is just like a statistical picture of America and saving. Nearly 6 out of 10 Americans don't have cash on hand for a $500 emergency. A $500 emergency. That could be a visit to the dentist's office. That could be a small repair on your car, changing your brakes or, changing tires. But 6 out of 10 Americans don't have $500 to take care of that, which means that they're relying on debt in order to finance their current lifestyle, right? The average American household has close to $17,000 in a credit card debt alone. And, we're talking to alums of Suffolk here, right? So many of us have had to finance our education with student loans. And the average American, average student with loans has over $50,000 of student loans, more debt, right? And then the average American in their 60s have only saved $172,000 for retirement. Back in the day, people used to, work until their mid 60s, but the lifespan was a lot shorter, right? People would expect to retire for 15, 20 years. But now more people are living well into their 90s and hitting their 100-year mark. So you have retirement periods of 30 plus years, which means for somebody that only has, $172,000, that's just short of $6,000 to live on every year. This is a real crisis that's facing us. The good news is that this doesn't have to be a thing where we suffer because we've got a magical tool that I want to talk to you about. If we can go to the next slide. And that magical tool or the concept I want to talk about is the time value of money. So what Jim was talking about, all those different investment accounts, what they are just houses, right? Places to put your money. But once you put your money in there, your money has to go to work for you. And the time value of money is a concept that just says the money you have today is worth a heck of a lot more than any money you have tomorrow. And the reason why it's worth more today is for this beautiful, wondrous gift that the finance gods have bestowed upon us, if you will. And that is the concept of compounding interest. In the next slide, you have a graphic here of what compounding interest is. Now, this is a formula. Believe it or not, this finance guy hates math. I'm not particularly good at it, and that's why I rely on Excel and all my calculators to do the thinking for me. But this formula here pretty much explains that money that you park into investments, that's the A, the amount, that's the P, that's your principal, right? And if you invest, you part with your money, you expect to get some money back for parting with your money today. You get that in the form of interest, right? The beauty about compounding interest is this. Imagine for a moment that you live in a wonderful world where if you work somewhere, you work 40 hours a week and then you get paid for that 40 hours. Imagine for a moment that your employer not only paid you for the 40 hours you worked, the past 5 days, but also paid you for all the previous hours you ever worked for that company. And so, this week it's 40, but next week you're paid on 80 hours and the week after that and so on and so forth. How much money would you bring home every year? You would bring home a lot of money if you were always paid on all the hours you've ever worked. And that's exactly what compounding interest does. It not only pays you on the initial principal or the initial deposit that you put out in the world for it to be invested, it also pays you on all the money that previously was made off of your investing. And that's why it's able to grow exponentially. Okay, so we know the compounding interest is magic, okay? So in the next slide, let's just talk about a little bit about, what you should pay yourself. Jim talked about the importance of paying yourself first. Obviously, when you go for an interview, you go back and forth about the compensation you think is fair. The rule of 72 works off of compounding interest, and pretty much what it tells you is how much you would need to earn in interest for your money to double over time. Right? So in this graphic here, it shows that if you were earning, wow, my eyes are very, very bad. If you were earning like 1.5% on $10,000, it would take 48 years for that to double in value. And again, if you were earning 3% on your investment, it would take 24 years for that to double. And if it was 6%, it would take approximately 12 years. So just how Jim was talking about, that it's important that you have short-term and long-term goals, right? Let's say you want to buy a house in the next 2 years. You don't want to park your money somewhere where the risk of losing your capital is so great because you're trying to get that top return. You want to park it somewhere safe in a bank account, something that you know that when it's time to write that check for the deposit, that it's there. But the beauty about being a young professional and starting to save right away is that you can weather so much more risk, because you're not retiring in 10 years and 15 years. You're more likely retiring in 30 years, 35, 40 years, right? So you're not worried about money that's going someplace, because you know that the more risk you're taking, the more potential for reward you've got. But that's a decision you have to make based on your goals and what we call a time horizon. But the rule of 72, how you calculate it is you take the number 72 and you divide it over a percentage amount, and that will tell you approximately, it's not exact, but approximately how many years it will take for whatever you're investing to double. So if you feel that you need, X amount of dollars in 5 years in order to do something, that should guide you into what you should expect, what kind of return you should expect on your investment if you're going to reach that goal. Does that make sense, guys? All right, let's go to the next slide. So why start saving right away? The big reason why you should start saving right away is the truth. The fact of the matter is, most of us, there's not that much distance between living a comfortable life, living, using that Suffolk education that now we're getting. We have great jobs, we have great careers, but there's not that much distance between living a comfortable life and poverty. Most Americans are one medical bill away from poverty. Most Americans are just one car trouble away from, not being able to make it to work on time, and then it's causing a job problem. They're saying we have to let you go because you're not reliable, right? Most of us are just one big. Those of us that have kids are just, one big daycare bill away from, okay, somebody has to stay home, so our income has shrunk because we can't afford daycare. A lot of us are just one life event away from really hitting rock bottom. So saving right away, what that does, it allows you to put away that cushion, just like Jim was talking about, that emergency fund. So when life happens, it no longer is an emergency, it's just a nuisance, right? Because you've got the funds to deal with it. It's like, oh, that sucks. I just wrote a check for $2,000, but I had that $2,000 and now I'm not in debt for it. Does that make sense? The second one I like to say is, and Jim touched on this. Jim, I love that we're in sync on this. You touched on this before about the flexibility that emergency fund and saving gives you. For example, when I got out of the Marine Corps, I saved, I created an emergency fund. I knew I was going to school full time. I was just going to be on a stipend, and, that I knew life would happen. So I wanted something to rely on. Thankfully, nothing happened during my time in college where I needed to draw from the emergency fund. But what it did allow me to do is when I graduated college, I was so chill. I didn't have to go around scrambling, looking for, saying yes to the first job opportunity that came at me because I knew I had that cushion where now I could go out on coffee dates and create opportunities for myself because I wasn't stressed about money. It gave me flexibility to say yes to a job opportunity that was ideal for me. The third thing is that it allows you to take greater investment risk, which equals greater returns. So if you're a young professional, member of Gold right now, the amount of money that you need to save today to make millions of dollars is a heck of a lot less than what you'll need to save tomorrow, 5 years from now, 10 years from now. So money saving today is so much cheaper than saving tomorrow. The truth is, not saving early and regularly could very easily cost you $1 to $2 million of potential retirement savings and 10 plus extra years of you working in order for you to retire just decently, not in the lap of luxury, just decently. That's why it's so, so important. So I just want to encourage you all on the call to really think about what your goals are. Think about when you want to achieve those goals. Write down how much money you need in order to achieve those goals and figure out how much you need to put away starting today in order to reach all of those individual goals. It is well worth it. You'll never regret having saved more money and living a little less. And that's all I have. I guess I'll go back to you, Tyler, and we can take some questions when you're ready.
Yeah, all right. Marlon Wesch and Jim Dever, thank you so much for a great presentation. We have a ton of questions, so I've tried to do my best to organize those. So the first question is, as people might have debt, either student loans and credit card debt, this is kind of a couple of questions combined here. How should people prioritize their debt, and how should people who have credit card debt try to save and pay down that debt at the same time?
So I'll take a stab at this, Jim. So this is one of my favorite questions. There are a lot of financial gurus out there that have this concept that you should pay off all your debt first before you invest and save. Get rid of the debt and then you can save. I think that's crazy, and I don't only think that's crazy. Math thinks that's crazy. I think when it comes to figuring out what you should pay first, you got to think about what your debt is costing you versus what not saving is costing you, right? So if your cost of debt is, like a student loan, generally speaking now, most student loans average anywhere between 4% and 6%, right? For those of you that have student loans that are hovering around 4%, I encourage you to invest, because if you're investing for the long term, you can very realistically expect to get returns anywhere from 7 to 9%, right? Without doing anything crazy. So it would make so much sense for you to get that money, because guess what? You can't borrow for retirement. You can borrow for school, you can borrow for a house, you can borrow for everything but in retirement, right? So it's important for you to do that. Now, if you've got credit card debts, which typically are high interest, right? Average credit card interest rate is like 17.9%, something like that. You're not getting that in the market. You may get this 1 year, but on average, you're not going to get that in the market. So it would make sense for you to get rid of those high interest loans, that credit card debt, because, that's costing you more than you can actually earn. But that's the math thing. And then there's also the legislative thing. There are protections for your 401ks and for your IRAs, right? The government has said creditors can't touch those. So I want to bet on me. I want to bet on me being old, and at some point I won't be able to work and being able to live off of that money that I've saved. And once I've taken care of me, then I'll take care of those other people, because right now the odds are against me if I'm not saving. But if I'm saving, the chances are that I have greater flexibility to, even in the future, pay off debt at a higher rate. I always want to bet on me and bet on my future, not on the coffers of an organization collecting debts.
And I just want to add a little there, no one should keep credit card debt, and I know people did. I'm a grew up in the 80s. So I learned not to keep credit card debt in my 30s and 40s. It's just bad debt. Student loans, I agree, good debt, pay off over time. Everyone, whether you have credit card debt or not, should save something. I don't care if it's $5 a paycheck. You need to get in the habit of that regular savings plan. As you get increases in your wages, put that increase into your savings plan until you get that emergency fund. But everyone needs to be in the habit of saving no matter what.
Awesome. All right. So I really like those comments too, because right now federal student loans, you're 0% interest, and so you're saving money there. And I always look at my student loans as an investment in myself from my education. So whenever I have to make that payment, I think it was an investment, not I'm just paying away money to student loans. All right. I think Jim, why don't we let you kick off this question? It looks like somebody said you mentioned to pay yourself first before paying bills, but shouldn't you pay for bills and debt first? So how much extra should you have to save?
Again, that's really a utilization of a budget and figuring exactly what you have to spend on a monthly basis. No matter what, you should save $5. If you truly don't have enough money to pay all of your bills, that gets into another story of you need to do two things: lower your monthly expenses, maybe get rid of things, or get another job and make more money. When your budget isn't equal, there's only two things you can do: lower your expenses or raise your income. That's it. So if you haven't done the budget, then that's the first thing you do. And no matter what, part of your budget should have a savings item, line item, and something in there. I don't care how small it is, there needs to be something in there.
All right. Thanks, Jim. Another question, this is kind of on the other end of the spectrum, is what if you don't know what your goals are yet, but you have a house and student loans and you're saving money, but you don't really know where the best place to put the money is or what to do with it right now. Marlon, do you want to take that one?
Sure. So, there are different ways of making plans for your money. I'm a huge fan of goals-based planning, but I understand that the goals change, and also that if you're young and you don't have anybody depending on you, chances are that your brain is not thinking in a long-term way, because all you have to do is take care of yourself, and that's a lot easier to do than to take care of a family, right? So in that case, what I would suggest is that you split up your savings into buckets, right? A long-term bucket and a short-term bucket. A good thing for you to do when we talk about emergency funds, that's not something that you continue to add to. But if you've parked 6 to 12 months of money in cash, that should be good. And depending on your work industry, right? Like how easy it is for you to get a job after you quit one or get laid off or what have you. But anywhere between 3 to 12 months of cash, that's great. If you spend some money on an emergency, which that's what it's for, put that money back and then move on. And then you have a long-term bucket that that you're not going to touch this for plus 20 years. And then you can have a middle bucket where you're expecting that, okay, I don't know what I'm doing now, but in 5 years, I may want to buy a house. And so you just divide it into those three buckets. And then that will give you the flexibility to have cash on hand when things change in your lives. And then as goals come, then you can be more scrutinizing and say, I need X amount of money for this goal at this time. When you make a money plan, it is outdated as soon as you walk out the door. This is a process that you keep doing because life happens. So what I would say, emergency fund, short to midterm fund, and then a long-term fund. And then you decide, percentage wise, what you're allocating to that. But I guarantee you, life is going to happen. So you're going to have goals, and then you're going to realize, okay, I need to be putting more money to a long-term or a midterm fund, and you'll be perfectly fine. The muscle of saving is what's the most important, like Jim said.
Awesome. Thanks, Marlon. All right. I know I try to have different buckets. I had at one point a bucket for a new car or a new truck, and that has now been pushed more towards new house fund because of how crazy the real estate market is. So I had to make those changes on the move. All right. Another question here is, and there's a couple kind of related to this, is diversifying money, which both of you touched on. But is it recommended? There was a specific question around diversifying your portfolio as you get closer to retirement and moving either to bonds or keeping them in stocks, and different ways to stay diversified. Jim, if you want to take that one.
I was going to recommend Marlon. That's kind of his job there. So
yeah. All right.
So this is interesting. I'm actually very interested in this topic right now. You know, doing my job, you're always learning and markets change. The old adage has always been to have, you know, kind of like a 60-40, 60% stocks, 40% bonds, because they would work kind of opposite. You know, when stocks are up, bonds are down, and vice versa. Well, the market has been really crazy for, I want to say the past 10 years or so, where they don't actually move in that, you know, in that inverse type of relationship as accurately as it did before. And that being said, diversification is important to handle risk. I will tell you what I do. I am only 33 years old, and I'm not expecting to retire anytime soon. But because I am 33 and I have my buckets, right? I have my emergency fund and I have my short-term thing. And so money that I put aside, I'm not worried about it. I do not have bonds in my portfolio because I don't need it now. I expect to year to year, some years lose 20% in my portfolio, and other years be up 30, 40%. Like, I'm expecting that volatility because I do not have, you know, any alternative investments to kind of counteract the stocks in my portfolio. But I'm young and I know I can do that. Now, would I suggest that for somebody in their 50s? No. And I think it's important as it is to diversify the assets in your portfolio. Income diversification is very important as well, right? So not all stocks are created equal. You know, some stocks, they go up based on appreciation, and other stocks, they don't really appreciate that much, but they pay a dividend. I think it's a good idea to have a mix of things in your portfolio that provide different things for it. Your time horizon is going to determine how diversified your portfolio is. If you're nearing retirement, you need to be pulling back on growth, and you need to be more in cash and securities that you know are consistent year in and year out. Not guaranteed, but still consistent. I say if you are young, if you are under 40 years old, I would say be aggressive as you should be given the funds you have outside of your investments. So it's really important that you're not relying on your investments to live today. If you feel you have to rely on it, that means you're not properly diversified. But if you don't care that the market is going up and down, take the payday. And make sure your bills are paid, make sure your emergency fund is fully funded, and you know the cash on hand that you need to do things, that's taken care of. You won't have a headache about that. And that's what I'll say about diversification. It's a really personal thing. Some people can't handle the ups and downs. Other people thrive on it. You should work with whatever is going to make you consistently save. That might mean that you have to pull back on the returns, but you know, you feel better because your portfolio is not going up and down, but at least you're saving consistently. Again, the muscle is more important than how much I can get in the market. I hope I answered that.
That was good, Marlon. And I think if you saw my IRA, you'd probably get scared at how aggressive I am.
No, I appreciate that.
But I'm under 30, so I figured even more aggressive under that point, right? All right. Kind of related to what you were just discussing before we jump to an earlier question, and I thought this was a good one for those that maybe aren't in the financial world. When you say you have or don't have something in your portfolio, is this something you're deciding yourself or something you can direct to an advisor? And if you sometimes feel lost around what, what should be in a portfolio, what does diversifying mean? Should you try to manage this yourself or get somebody to help you?
I always think you should reach out to professionals to help you with something that you don't have an understanding of. So I would recommend reaching out to a representative, or I should say a professional, to seek that advice as to what you should do. Your professionals that you're working with shouldn't necessarily be asking about specific investments, but about what is your timeline? What are your goals? What are you looking to do? Yes, you can always recommend them. Should I look at this as part of my goals? And they can look at, is this a high risk? Is this a low risk? Is this, do the fundamentals make sense? So nothing wrong with thinking about a certain investment and asking for the advice, but it isn't about the investment. It's about you as an individual. What is your time horizon? What is your comfort ability with risk? So the investment may do nothing if you're not comfortable with things going down. That might not be the right investment for you. So it really is something I'd recommend to ask a professional.
Tyler,
Thanks,
can I
Jim.
work off of that
Go ahead.
as well?
Yeah, go ahead.
Jim is 100% correct on this. And I just want to encourage you to not be afraid of reaching out to a professional. There are different ways. A lot of people are afraid that they won't be able to afford a financial professionals. And, look out there, because professionals, they all set their own rates. Some are very expensive, some are not. Some are very investment focused, some are very life focused. And a lot of them set their rates in different ways. You can hire a professional on a project base, to create an initial plan for you. And then if you ever need to go back to them, pay them an hourly something for them to look over your plan or answer questions. There are those, there are those that manage, your portfolio for you and you don't do anything. There are different levels of support you can get from a financial professional. The one thing I'll say is that always make sure you're working with someone who's a fiduciary, and which simply means that they're obligated, not just because they're a good person, but by law to do what's in your best interest at all times. It sounds like a no-brainer, but unfortunately our industry allows us to do things that are just okay and not the best for clients, which sucks, but it is what it is. So make sure you do your due diligence, that you're working with somebody that will say, yes, I am a fiduciary for you at all times. They shouldn't have to explain any more than that.
Thanks, Marlon. All right, and use your network, right? I know our Suffolk alumni network has a lot of professionals in that world. Some of them talking today. All right, this question came in a little earlier, but I thought it was a really good one. So IRA and 401k withdrawals and loans for home down payment. So do you suggest it's a good idea to take money out of your retirement to put down a payment on a home that you're trying to buy? Jim, I don't know if you want to
take this one. Many advisors will tell you, no, you want to keep your retirement separate. It's how I bought my first condo. So I used my 401k for the down payment out of that via a loan process, not taking it not taking the funds out, but loaning myself the money for the time frame and paying it back over 5 years. That was affordable to me. That made sense for me to be able to get that home that I didn't have the down payment for. So as I say to everyone, it depends on your particular situation, if it makes sense for that, and if the timing is right. You always have to consider the market. Where are things? And, is that the right time to actually pull some funds out? Because you're going to have to sell some of those securities in order to make that decision. With that said, purchasing a home is the largest wealth creator that anyone will ever have. So at least it has been for the last 50 to 60 years in America. And, with the change in the tax code, that may change. However, I still believe it is a good investment. And so I would recommend it.
Thanks, Jim. I know as a tax professional, I know if you're looking at an IRA and you're looking at a withdrawal there, don't forget, although you won't face a penalty for up to $10,000 to take out for a down payment on a home, you're still going to pay tax on that if it's a traditional IRA. So remember that even though you might take $10,000 out, you're going to owe part of that back at the end of the year, or you're going to have part of that withheld. So just keep that in mind when you're making those withdrawals, that it's not, a dollar for dollar contribution that you're going to be able to use from an IRA. All right. Another question here: if there's cash in a bank account making 0% interest, what do you have for suggestions to invest it to increase short term? So 6 months to a year with minimal risk was the question.
So again, everything is important with your goals, right? I hate talking about investments in the abstract because it means nothing to me outside of what's the job it's supposed to do. Money just growing for the sake of money growing, like I guess that's something, but I need to give my dollars jobs. That's the only way I know whether I'm being efficient with the job that they're doing. I have to be able to rate their performance. So if that money that's sitting at 0%, if that's for an emergency fund, I don't really care about that. I mean, could you get a little bit more? Yes, but I don't think, not significantly more. My emergency fund is in a money market, right? I don't know what it gets. It gets below 1%. But it's there. I know it. I know I can write a check against my money market and use it for emergencies if I want. But it's not supposed to be earning me anything. That's not its job. It's insurance. So insurance is not, I don't call insurance an investment. It's there to protect me against loss, right? Okay, now if I have that emergency fund and now I have other money that's just sitting in an account doing nothing, but I'm not sure what I want to do with it. Yeah, like look at a CD, right? You can get a CD for like 1.5%. Maybe you can't anymore, Jim?
No.
Oh my goodness. Maybe I've seen some of the online banks, some of like Ally and I've seen a 1.65 on a CD, but it's a long CD. It was like 5 years, 6 years, something like that. I think you should be okay with money not earning anything if it's for your use, your current use, right? If you need to invest it, invest it. But if you want it handy, the price of having your money handy is that it's not going to make you money.
And I'm going to just add another point here. Everyone is so technologically, let me just go online and I can get whatever I want and I can do it online. There are times you're going to find out having a relationship with a local bank or a banker can be invaluable. So doing things digitally is great. Getting the best rate, might be easy with doing things online. There is a point where you may need that close, that relationship with a banker to do other things or to get other advice, just to have something local. So I encourage people to always think about banking with a minimum of 2 to 3 banks, just to have options, with your emergency funds as well.
Awesome. Thank you, gentlemen. I miss the days of 5% interest on a 6-month CD. All right. Here's another one. Let's see. All right. If you're working about, a lower paying job right out of school, how do you make the decision about how much you should be saving or a percentage of your income that you should be saving?
Again, it comes down to a budget. It's how much can you put aside? As I say, even if you don't have anything, put $5. There should be something being put aside on a regular basis for when those things change, and to remind you, I still need to be working towards that emergency fund goal if that's not there. And a budget is, I'll say it again, if you're not making enough money, do you need to get another job? Or do you need to get a better paying job? I mean, these are all of the things you need to think about when your budget is lopsided and not where you want it to be.
Awesome. Thanks, Jim. Since you did just touch on budgeting, and also we've talked about budgeting a little bit today throughout the session, do you have any tools for budgeting? So I know I use mint.com, but do either of you have suggestions for budgeting tools and how to put together a budget or where to start?
Mint.com, that's a really popular one. One that I like is called YNAB. You need a budget.com. You do have to pay for it. I think it's like $11 a month, but it's very interactive. It's been championed by tons of financial advisors, ones that specifically work with Gen X, Gen Y clients. And what it does is not only the actual process of like the spreadsheet, but it helps you with your behaviors, because money is a behavioral thing more than we want to think that we're all rational. We make the best decision based on math and facts and data. The facts are that we don't. So I would, rather than being 100% right all the time, know how to manage my emotions, know how to manage my habits, because I know that's going to get me to the finish line more. What's the word I'm looking for? Regularly or reliably, than me just saying like, math says I should only spend $10 on eating out and what have you. So You Need a Budget is one of my favorite ones. You can try it for free, like 34 days. And it walks you through actually making a budget that works for you, and not just what's the best budget to do.
Awesome. Thank you, Marlon. All right, I think we have time for one or two more questions. What do you do if your company freezes retirement contributions? So is your 401k still worth it to make if they're not making, or is it still worth it for you to make contributions if they're not making a company match?
I think everyone should be saving for retirement on a continuous basis. If you're unsure of your company and maybe the investment options that they're giving you, then you should probably look at doing retirement, periodic retirement through your own individual retirement fund, whatever you can, if that's available to you. But everyone should be saving something for retirement.
And to piggyback off of that, I have like a PEMDAS type of relationship with saving for retirement. Starting with always take free money, right? So if your employer is giving you a match, take it up to the match at first, right? The thing with employer-sponsored plans, they have to go out. And hire somebody like Jim or myself to like service this plan for them, right? So they pay these people money to do that. So the investment fees that you're charged within your employer-sponsored plans are typically higher than the fees you would pay outside of your job. That being said, free money is free money, right? So you take the free money. If you have money that you want to keep investing after you've taken the free money, I would max out my Roth if you have that available. If you make less than there's a cap that how much you can make before you directly contribute to a Roth. Max that out, and if you can't do a Roth, max out your traditional. And then if you still have more money, then go back to your employer and max that out. Just because you're trying to get the most for your buck, and fees really erode away at what you're actually earning. So your employer, take that free money. If you have extra money that you want to save, max out your individual retirement accounts. And then if you still have money left over, go back to your employer and max out your 401k, 403b. That's how I put them in order of precedence.
All right, thank you, gentlemen. One last question. Federal student loans aren't accruing interest, and payments can be deferred right now, as many of us have seen in the news. So should you still be making payments on your student loans while this deferment period is taking place?
That's one of those situations that you need to individually look at your situation. So if you have the funds available and your concern is to get that paid down as soon as possible, from an emotional standpoint, the answer may be yes, but obviously paying down debt that you have that is earning interest is more important. So if you have other debt that's earning interest, that debt should be focused on first. Car loans, other debt you may have taken out for small purchases, credit card debt, those things should always be paid down first. If you don't have an emergency fund, no, don't pay your loans. put the funds towards an emergency fund to create that emergency fund, this is a great time to do that, because that's one of the most important things to have. If you have an emergency fund, you have other savings plans that you're working on, and you have extra funds, the answer is absolutely yes.
Thanks, Jim. All right, I'd like to take a moment to thank Marlon Wesch and Jim Dever very much for sharing their experience and knowledge. Marlon, you mentioned finance gods earlier. I think we have our own Suffolk finance gods here, and if that doesn't start trending or become a thing, I'm going to be pretty upset. This afternoon's webinar is part of Suffolk Week, a week of virtual programs and events for the entire Suffolk community. For a complete list of the events, please visit the link shared in the chat. This concludes the presentation, and I hope that you all stay safe and well.